Hi, good morning. Never shared this talk publicly before, but I've given it at a few investing conferences privately, and I thought it was time to make a recording, share it with you, start a conversation. This is something I believe in deeply, and I'm very excited to be able to share some of these ideas with you and have you challenge them. Let me know what you think. Hopefully, we'll bring you on board my train of zealotry today. Let me know how it goes. So, I came into venture sort of backwards through the side door. I was an operator first in venture-backed startups. Then I started angel investing in some friends. After a few years of that, started a small fund. And over the course of running that fund for a few years, have turned increasingly into a missionary for acceleration, technological progress. So now it's not just a fund. It's a mission from God. I'm excited to share what I think I know and see what you think. I want to start with the Peter Thiel question. What important truths do very few people agree with? And turn that into the question, what important truths are not being talked about? I think that's what makes an interesting conversation. That's what makes an interesting video or presentation. And so I hope I bring up some of those today. Get you thinking some new thoughts. What do I not hear talked about in venture capital? That we look like fucking idiots doing venture capital. Like, it's a fundamentally absurd undertaking. That's one that I think everybody takes this really seriously. And it's serious to manage other people's money, but it's an absurd game that we're playing. And I think that's why people take it so seriously, because if you didn't, it would look silly. But I embrace the silliness, and I think it's fun. I think it's an important conversation that's not being had, that most people who are working under the label of venture capital are not doing real venture capital. We'll get into that a little bit in a minute. And then the third important piece here is that career risk absolutely dominates decision-making in capital allocation. And if you don't understand that, then there's a lot of behaviors in this world of finance and capital allocation and fund management that just make no sense at all. So I want to pull those up to the forefront. Again, starting a conversation, trying to learn. So if you hear something here that you disagree with, leave me a comment, shoot me an email. I'm happy to have the conversation, and I'd love to learn. So a little more about idiots. This is kind of what defines a power law game, which is what venture capital is. You have to obsess about a few things. Mark Andreessen says, it's not about what's wrong with a company, it's about what's right. You have to find the things that are going to really drive an incredible outcome. You have to ignore non-critical variables, even though they might smack you in the face with how obvious they are and look like existential threats to the company. If the good things are good enough, they may not. Another thing is that we can play this game right. You can play your hand perfectly and still fail often. And you just have to take that, ignore it, accept it, and keep moving. And then maybe the cruelest trick of all is that even when you win, it looks like a fluke. This is so extreme. One company tends to be the returner of an entire fund. So much so that Sequoia refers to their funds as the Uber fund, the Google fund. These one investment will dominate and outweigh dozens of others. And how does that not look like a fluke? No matter how smart the process or people or how much work went into it. And that's an absurd thing. So this is kind of where I find myself thinking back over and over again in venture. There's a lot of talk about the seriousness of, the entry price, the ownership targets, who does what's in scope, what's out of scope. And all of this is important for fundraising and important for LPs, but it misses some of the most important pieces, which is will this be a fucking enormous company? And if not, it doesn't matter how good the entry price was. It doesn't matter if you reached your ownership target. It doesn't matter if you went a little out of the bounds of your normal kind of charter for your fund. The paradox here, of course, is always you can never really be the guy on the right. You just have to embrace that you're the guy on the left and just try to avoid being the guy in the middle. But I think this describes a lot of the conversations that I hear in the world of venture. And I try to just always, be a wide-eyed thick-headed guy who does not compromise on, well, will it 100x? It's a real simple flowchart. More Teal quotes because I love them. And I think he's one of the greats of this industry. And part of it is keeping focused on these insane outliers. So, his great quote, this is from 0 to 1, his book from quite a few years ago now. The best investment in a successful fund outperforms the rest of the fund combined. This implies two very strange rules for VCs. First, only invest in companies that have the potential to return the value of the entire fund. Rule number 2, because rule number 1 is so restrictive, there can't be any other rules. Which, going back to our midwit chart, there's a lot of people coming up with a lot of rules that are not the core essence of the critical variables that drive the returns in venture. So, what are these things that are happening in this world of venture that are not following these rules? There's a lot of action under the umbrella, under the label of venture capital that I reject and push away and don't want to be associated with our industry and our craft. So I cringe when I hear, oh, we're a venture capital firm that is consumer packaged goods focused. It is very rare to have a CPG company drive venture scale returns. Venture capital is not regionally focused. I hear lots of funds say, we do startups in the Western Idaho region, or we do startups in the Omaha region. It's not to say there aren't wonderful startups in Omaha, but there are probably not enough to sustain returns for venture scale. This is an economic development organization, not a venture fund. And more importantly, the reasons back to career risk and other decision-making frameworks, these are not why these funds are easy to raise. They're not actually return optimized. Venture capital is also not financing for bootstrappers. There's a whole lot of money and effort and narrative going into like small cash flow software companies that sort of operates or adopts the label of venture capital. That's not venture capital. So what is it? It's also not B2B SaaS. Goddamn. All right. So there's venture capital, I think, is going through this moment of being fully prepared for the past. It's always accused of being sort of a lemming-like industry with some credibility to that claim. And so you'll see firms sort of adopt a strategy that was the strategy that worked 5 years ago. And it's this backward-looking sort of pro forma to fit the narrative of what happened in the past. And so we've had, this is starting to change now, and God bless, but we had a few years where big firms with big funds would say, oh, we only do B2B SaaS, as though that's the only place that venture returns would come from. And ironically, they moved towards that just as B2B SaaS was exiting prime years of driving venture returns, in my opinion. Like, time will tell. But when you get this focused on one specific thing, you stop doing what is really the craft of venture. And to me, that is seeking, finding, and financing companies that add new capabilities to humanity. I love when I meet companies that have a credible claim towards either saying or working towards saying, we are the only company on earth capable of blank. Not only is this the most exciting stuff to invest in, not only is this the best thing for humanity, it's also the place where the greatest returns come from. And this is so obvious that it doesn't even really need to be stated, but it's forgotten. It's lost in the fluff of the midwit curve. And people make all kinds of decisions and make all kinds of investments from venture funds that don't respect this sort of principle at all. And it drives me nuts. Not just because I think, it's suboptimal for LPs, but because I want to see humanity add new capabilities. The whole reason I'm here giving this presentation, the only reason I'm here in this industry is to help advance humanity, is to help move progress forward. It's to help heal more people, extend lifespans, expand to the stars. I want to live through the next industrial revolution. And that's possible if we collectively get our shit together and get the resources to the engineers, the scientists, and the entrepreneurs who are building these new capabilities. And then they'll expand out to all of us. All of our lives will get better. We'll lift billions out of poverty, and we'll continue to live in an era of abundance, and even more so in the future. But not if we only fund bootstrap B2B SaaS businesses from Western Idaho. And that's why I get so fired up about this. Because through God's eyes, if you were playing humanity in The Sims, venture capital is far too small and far too sloppy. We're responsible for the sloppy. And if we fix the sloppy, I think the small will take care of itself. We are responsible for funding the frontiers that are expanding humanity. We have to take this responsibility. We have to do it well. This is what I mean when I say too sloppy. Like, look at these return dispersion. Like, when we as an industry are at our best, we are the best returns that you can find in the world of finance. When we're at our worst, we're the worst returns you can find. And my strong suspicion is that these terrible returns come from people who aren't really doing the craft of venture capital as I defined previously. I think there's a lot of Western Idaho bootstrap B2B SaaS for dogs. And I want to push that away, encourage people to elevate themselves, lift their sites, invest in more technology, more companies of singular capability, because I want our venture returns to go up. I want more assets to flow into this asset class, and I want more progress to ensue as a result of that. Third point, career risk dominates decision-making in capital allocation. Or put more simply, everyone's first job is to keep their job. Coffee break. This point is so important and so underappreciated. I'm still relearning it even now, a few years and hundreds of conversations into talking with capital allocators, talking to people with family offices, talking with LPs, talking with endowments, even other GPs. These are good fucking jobs. These are cushy jobs. These are great gigs, and everyone wants to keep their job. So a lot of decisions are made first and foremost for people to keep their jobs, not to maximize returns. And so there's a lot of early investors who are running around making great cases, showing their track record, and they're met with blank stares from LPs because they don't have the right fund size. They don't have the proven track record. They don't have the audited track record, even though they have great returns. It's just too much of a career risk for the allocator to take. And that becomes a problem because what sells venture funds is the opposite of what produces returns. There's a reason that people do B2B SaaS in Western Idaho, and it's because that's what can sell funds. That's what brings in AUM. That's what helps venture managers earn a living and keep their job. And that's what helps allocators keep their job. There's all kinds of things that they need to do in order to satisfy their requirements. One of those things, you ever hear the phrase like, nobody got fired for buying IBM as a procurement officer? That there's just like, IBM is so big that there's a general consensus that they are the agreed upon vendor. And if you hire IBM and they fail, you as the hirer of IBM is not responsible. Your career is safe because it's IBM's fault. And obviously we can count on IBM. I think we see a similar dynamic in VC. It's very clear from this chart over time that smaller funds outperform. Smaller funds have higher returns. Some of the greats of venture capital have returned incredible multiples on small funds. One of my favorites is Steve Jurvetson at Future Ventures. He raises a $200 million fund like clockwork, never a dollar more. Long Ventures or a Long Journey Ventures raises a $150 million fund like clockwork. these are funds that are easy to return. These are funds that drive high ROI. As you see these like mega funds grow, the bigger these funds get, the lower their returns get, but the money still flows in because these endowments, these allocators, family office, managers need to keep their job. And if they go with a bigger fund that has a longer track record, that's more proven, it's a safer play for them. This is fixed in some cases, and you'll meet people with different incentives. But the world starts to make a lot more sense when you see it this way. And when you start to look at career risk as the driving decision-making force. So one other takeaway I have from this chart is just more smaller funds are better. Keep your fund size small. I adopted a Ronnie Coleman quote here, but everybody wants to deliver high returns, but nobody wants to raise a tiny fund. This is true on the GP side. Most GPs are trying to increase their AUM. They make more money sooner on management fees than carry, certainly. Though Bryce Roberts has a great quote that says, if you don't get rich on carry, you won't be in the game long enough to get rich on management fees. I would love to believe that's true, but I think there's a lot of people getting rich on management fees that may or may not ever really deliver big on the carry. These feedback loops are very slow, and it takes a long time to determine if someone's truly good at this. So this is true of like no GP wants to raise a small fund, but also LPs don't want to invest in a tiny ass fund. Even though demonstrably that's where some of the returns are. It's just often too weird, too risky. And so there's a benefit to scale here to a certain point. Like a lot of endowments just cannot structurally invest in a fund that is, earlier than fund 3 or is smaller than 75 million, which actually is where a lot of the returns come from. And most critically, actually, is where pre-seed and seed checks get written from. It's really hard to run a good return on $100, $150, $200 million seed fund. You have to hit many huge multiple investments or be the main check into quite a few to return a fund of that size. So if you're in a pre-seed or a seed fund, what you actually need is like 10, 30, 50 million, maybe a little more. But to return that fund, you need roughly that fund size. And that's just like structurally inaccessible to many of the bigger LPs, or just uninteresting to some of the bigger family offices who need to write bigger checks and they need to see longer track records to do it. But I think, again, playing the game of looking through God's eyes at this industry and at what's happening in it, a wider diversity and a much greater number of smaller funds is actually optimal for getting the most credible pre-seed and seed funding rounds done. Getting these companies off the ground, getting them off to the races, getting them to a place where the technology is proven or the market is proven. The founders have something to demonstrate and they can access the bigger capital in that Series A, Series B tranches that come along. So more smaller funds. I would encourage you, if you're an LP, to try to figure out how to invest in these, 10, 20, 30, $50 million pre-seed and seed funds. I think you will get good returns. I think you will be doing an excellent service for humanity with that capital. And if you need help, I've got a list of people at the end that I recommend. I'm happy to connect you with them that I think are very credible small fund operators here. All right, so this concludes my first leg, which is venture capital being so counterintuitive, it seems absurd. My next soapbox that I'll step onto next is that investing in technology is a moral imperative. We lose sight of it so easily, how disgustingly uncomfortable and painful and suffering filled history has been. It's only really in the last few hundred years and even the last 50 that we truly know peace and comfort. And that's thanks to generations, thousands of generations of brutality and hard-won lessons of knowledge and technology and the slow grind of progress that our ancestors made towards where we are today. And now the ball is in our hands. We have to keep moving this forward. It's hard to imagine how much better the world can be, but that's what we're going to try to do. thinking back 2,000 years ago to the slaves or peasants and thinking about those conditions and imagining ourselves in them, painful and scary. But what we lose sight of is the fact that if progress continues, we could have another order of magnitude leap in a few hundred years. And, our grandchildren, our great grandchildren could have the same sort of leap in comfort and mind blowing abundance and look back at us as suffering, in roughly the same category as the ancients, as we see them in history today. So all of this to say, I want venture capital to thrive. This is the industry that has given us Apple computers and Genentech and 23andMe and SpaceX and Tesla and all kinds of miracles of technology that make our lives good today. And, no shade to real estate. Some of my best friends work in real estate. But if venture capital had the tax advantages that are given to real estate today, I think we'd live in a different world. And I want to see this continue to advance. I want us to get less small. I want us to get less sloppy. I want us to have more tailwinds from a regulation perspective, from a tax credit perspective, and I want the craft of true venture capital to continue to grow, because I think mind-blowing abundance is on the other side. And I know this has been a little abstract, so I'm going to talk through a few actual specific companies here. One is Adam Limbs. This is a bunch of former Apple and IDEO people. They are building a new mind-controlled robotic prosthetic limb. We have all the technology. It's been in labs for quite some time, but no one has done the hard work of commercializing it, putting it all in one package. Now the limbless, market is quite a bit bigger than you might think, but what's more exciting to me is the medium term and the long term of increasing health spans, of replacing sort of ailing human parts, or even whole human bodies as we continue to advance our understanding of cognitive health and brain health. I think that's really the final frontier, because we can start to really supplant our bodies. And, if we can, robotic prosthetic legs can keep people from falling, that alone will probably add 5, maybe 10 years to a lot of people's lifespans. So very interesting work happening here. I encourage you to follow them. Allo Atomics. This is a bunch of former Idaho National Lab researchers that are commercializing a new reactor design, a microreactor design for fission. They believe and have modeled out that they can get to 3 cents per kilowatt hour electricity generation. The current US average is about 16. So imagine your electric bill going down to 20% and all of the follow-on effects that come from having energy that cheap. I've got a few energy ones because it's so fundamental to everything. So another here, batteries, incredibly important foundational technology, and actually underappreciated in the role that they played in unlocking the smartphone revolution. We pretty much give Steve Jobs all the credit, but there were quite a few enabling innovations in underlying technology, and one of them was batteries. The same thing is happening with electric cars. People have been building electric cars for a long time, but it wasn't until modern lithium-ion batteries that it really became feasible. And there is the possibility of another breakthrough represented here in Oros. We've sort of been for a few years on like an asymptotic curve where battery progress is flattening out. We're still making progress. Ranges are getting longer. Charges are getting longer, but we haven't had a big breakthrough. And I think Oros could be the big breakthrough. 1,000x energy density versus current lithium-ion battery. Sorry, 1,000%, 10x. Which would mean your Tesla goes from a 300-mile range to a 3,000-mile range. Your laptop and your phone could go for a week without needing to be charged. We could store energy from solar or wind and power shift renewable energy quite a bit more. And perhaps most interestingly, drones and electric jets and electric vertical takeoff and landing aircraft become very feasible at this power to weight ratio. So I'm incredibly excited about Oros as an enabling technology. And then finally, Terraform Industries. This company absolutely blows my mind. I highly recommend following Casey Handmer if you don't already. He's very brilliant. He's the founder of this company, mathematician and physicist, an engineer. And what he's been charting for years is this sort of decline of the price of solar photovoltaic power, solar energy. And as we were getting really, really good at building solar panels, we're installing a ton of them. That curve is taking off, which means the price of solar energy is going down. And he's charted this out and realized that once solar energy becomes a certain level of decreased price, it will actually become feasible to run this process called the Sabatier process, which pulls carbon out of the air, which reduces climate change, reverses climate change, and fuse it with the hydrogen from water and produce CH4 methane, which is basically synthetic natural gas. So we'll no longer necessarily need to drill for oil, for natural gas. We can create it at a solar farm by pulling the carbon out of the air. And this closes, you know how we have the water cycle where like it rains and it evaporates and it rains and evaporates. We can have a carbon cycle where we pull it out of the air, turn it into natural gas, burn the natural gas for energy, and carbon goes into the air, and then we pull it back out again. And Terraform has closed that carbon cycle and built the machine that we need to exist at the bottom of this thing. So it breaks the dependence on fossil fuels, enables anybody with sunlight to generate their own natural gas. Really a mind-blowing company. Also really lets us long-term store solar energy. And that's a lossy conversion. But if we have enough solar, it is still worth doing. So they've got some incredible posts, and Casey's a great speaker, so I highly recommend checking him out. So all of these companies just make me so optimistic about the future and just break my brain. And this is why I say it's a moral imperative. These are the companies that make our lives better, even if we don't necessarily know why our electricity is getting cheaper or who's building the battery that makes our Tesla go longer. All of this progress that's happening in the background is a huge benefit, and it enables greater population, greater problem solving, greater peace, greater ease, less conflict, less war. It's very exciting. And to take that to the next level, and this is kind of my closing point here, it's not just that technology is good, it's that if we play our cards right, we can invest in the next industrial revolution. There are so many exciting things coming. Those are just a hint. My big induction to this set of ideas was from Josh Storrs Hall's incredible book, Where is My Flying Car? It's really tracing why we don't have flying cars, even though they were predicted by all of the kind of smart scientists and science fiction writers a few decades ago. But really, the book is a case for the next industrial revolution and what it would take to get there. So he's got a great passage here, and I'll read it to you for those of you who are just listening. 3 interacting and mutually accelerating technologies in the 21st century are likely to be nuclear, nanotech, and AI in a synergy I call the second atomic age. It could easily improve productivity another couple orders of magnitude. You may have trouble envisioning the world after another industrial revolution. I certainly do, and I've been trying for some time. So I find this endlessly fascinating, and I really want to plant this seed with you so that you can sort of dream a bigger dream, in being optimistic about the future, but also in hopefully, ideally, how you invest, the companies you choose to start, the companies you choose to go work at, how you allocate your attention even, or your respect in the world. I think the builders need our support, and if we work closer and closer to the frontiers, that's a source of energy and optimism that I'm really excited to be a part of, and I hope you are too. So what does this next industrial revolution look like? What does it look like to go up another order of magnitude or two in productivity and abundance? So the first one, which we've talked about a little bit, is just energy, and energy too cheap to meter. Right now you pay for your electricity on a usage basis. And that price goes up and down depending on who's using what energy when. It's very possible that if we generate enough energy, it becomes so cheap that we don't even bother to track it. This actually is how we think about bandwidth. You remember, having to pay by the minute for phone calls, especially for long distance phone calls. And then now that we have so much data bandwidth, you just pay a flat rate per month for, your fiber optic internet hookup or your cell phone plan. Because each individual call or each individual, megabyte stream is just too cheap to meter. That's not true in every country, but it's true in America today. And if we play our cards right, we can have energy that's too cheap to meter. Maybe you'll just pay $30 for a flat amount of electricity, and you can leave the lights on and you can leave the fan going, and you'll never get, yelled at by your dad for leaving the lights on again. This is incredibly important because energy drives so many other things. It's the fundamental cost of things like desalination, which drives, which could produce limitless fresh water. If we have a bunch of fresh water, we can terraform deserts into gardens. Energy is also the driver of things like flying cars. It takes a lot of energy to get something off the ground and keep it up there. But if we have a bunch of energy, we can do it. This gets a little more into nanotech, but with fresh water and robotics, which again needs energy to drive the robotics, we can have fully systematic, verticalized farms that grow plenty of food for everybody. We can have robots building shelter for all humans. This is all doable in a few decades. We can all live through this if we play our hands right and if we get the capital to the right people and we support the builders and we create the right policies to enable innovation to move as quickly as we possibly can. Getting a little more crazy in the right-hand column, we can build hundreds of Hawaiis. We have this beautiful strip of like perfect weather all around the world, and we can create new continents, new archipelagos, new chains of islands in those ideal climates. Why not? We can make space elevators. We can have giant towers of diamond. We have giant buildings. There's a great passage in Where's My Flying Car that talks about a perpetually airborne cities, which is just an enormous wing. It looks like a space station, almost like the Death Star or something, like the giant battle cruisers in Star Wars, but they're just like orbiting the Earth at a relatively low pace so that you could go back and forth. Certainly cities on Mars, factories in space, colonizing the solar system. You don't have to go to Neptune for it to be exciting that humans are on Neptune. And there's incredibly good things that come from us having that kind of expansion. This is how we gather more raw materials. This is how we unlock new knowledge. This is how we, even if you stay on Earth forever and all your future generations do, we will all benefit from space factories, from space travel, from interplanetary travel, and all of the things that are coming from it. So I want to end here. There's only one or two more slides, but I think this chart is the most important chart of the last 50 years. Are we familiar with like Moore's law and how the amount of compute that you can buy for $1,000 has continued to fall thanks to the hard work and engineering of, all of the chip engineers and NVIDIA and Apple. And, so for basically the entire history of computing, we have made progress in how much compute we're able to create and from a cost efficiency perspective as well. And that has basically defined our era of progress. We've got phones and computers and the internet and Instagram because of that progress. Now for 150 years, maybe more, we were on a very similar curve with energy consumption. This is also Josh Storrs Hall. He calls it the Henry Adams curve because Henry Adams was one of the first people to observe it. And for years and years and years, decades and decades and decades, we were on a steady growth. And this is what drove a lot of the boom times in America in particular. But we have fallen off of it since the 70s. We basically flatlined in energy consumption. And he makes a case this is some combination of cultural issues and regulatory issues and the culture of conservation actually and environmentalism sort of gone awry. A lot of environmentalists are now protesting clean energy technologies like nuclear instead of supporting them because we don't know why. Anyway, this graph shows us two very important things. One, we can regulate and culture and stumble our way off of these growth curves. We cannot take anything for granted. We must continue to invest and build in the things that advance our civilization, that create further abundance, that reduce scarcity. And the scarcity is terrible because it makes people turn on each other. It creates this zero-sum mindset. People stop helping each other. People start fighting wars. More suffering, less progress. So progress, abundance, technology improvements, is the world that we all want to live in. So what I have to believe here is that we can regulate and innovate our way back onto this curve. We have to do this. We have to work on it. So this is partly why I focus so much on energy. All this to say, I want you to take away two things here. If you want to have a great positive impact and you want insane financial returns, you can take both pills. You can do the same thing. You can do both with one move, which is, to me, investing in venture. So a few people you want to follow here. I highly recommend following all these people, most of them on X. If you'd like to invest in us, I'd love to have you. If you don't invest in us, check out some of these other people. If we're not a fit for you, invest in all these people. A lot of them I know personally, but others I just know are of the same mind, of the same philosophy, working towards the same thing. I'm incredibly excited to be a part of this alliance. So thank you for listening. Appreciate you. I'd love to hear your comments. And I'm excited to see where this goes.